HDFC FlexiCap is one of the oldest funds in existence from 1995. This fund has given a stupendous return. Since the beginning, rupees 10,000 invested would be rupees 11,98,000 now. It has compounded at an annualized rate of 18% per annum. A SIP of rupees 1,000 per month since inception would now be worth 1 crore 22 lakhs. It has generated 20% annualized return. But the question is, how many investors could participate in this compounding journey? Very few. Even in the future, if such a performance is going to repeat, very few investors will be able to participate in this wealth creation opportunity. The reason is VUCA. The world around us is engulfed with volatility and complexity. The only thing certain is uncertainty. We are surrounded with geopolitical instability, threat of nuclear wars, election upsets, coalition government, high inflation, and a very aspirational generation. Everyone has heard of Warren Buffett, who made his fortune through investing. But here are some startling facts not known to many. Morgan Housel has documented this in his book, Psychology of Money. He started investing as a child. His net worth in 2020 was $84.5 billion. Of that, $81.5 billion came after he turned 60. If you feel he became wealthy due to his investing acumen, you have missed the point. His real secret was time. He invested for more than 75 years. That's how compounding works. If he had retired at the age of 60, not many of us would have even heard of him. Here is another story. There was another fund manager who compounded wealth at 66% annually since 1988, Jim Simons. No one comes close to him. 3 times Buffett's returns. His net worth, $21 billion as of 2020. Buffett's, $84.5 billion. In spite of compounding at 66%, Jim Simons' wealth was only 1/4 of that of Buffett's, who had actually compounded at 22% only. Simon was a better investor, but he did not start until he was 50 years old. He only had half the time as Buffett to compound his wealth. This is the formula for compound interest. Although many people tend to focus solely on the annual interest rate, that is R, it actually only has a linear impact on the outcome. The true effect of compound interest lies in the time component represented by the variable t, which has an exponential factor. This geometric change is often overlooked, but it can have a significant impact on the final outcome of this equation. Therefore, it is important to take into account the time factor when considering the real effects of compounding. That's how a simple SIP of rupees 1,000 over 27 years has created a wealth of 1 crore 20 lakhs and annualized at 20% return. This is the risk and reward in the past 22 years. 2000 to 2003 was boring, 3 years of no return. Disappointing period, many would have lost patience. 2003 to 2007, 4 years of amazing returns. 2008 to 2014, a period of 6 years of low returns, the most testing time in Indian equity. 2014 to 2020, market did exceedingly well until the COVID crash. 2020 to 2021, again was a period of great returns. 2021 till date, market has been sideways without much returns. Accounting for all corrections, good and bad times, market has compounded at 14% over this 22 years. Long-term investors have to be ready for this journey. The horizon of equity investing should not be 1, 2 or 3 years. It should be in decades. That's how wealth is created. Today, the fear of dying young has been replaced by the fear of living long. Lifestyle inflation needs to be met with long-term thinking. That brings us to the end of this video. If you liked it, please do like, share and subscribe to this channel. Thank you.